I think we can get started. We have enough people signed on right now. Um, so my name is Nancy Neerman. I am the Assistant Director of the Education Debt Consumer Assistance Program. I'm here with my colleague and the Director of the program, Carolina Rodriguez, who is having some issues with her camera, so she's gonna stay off camera for now. I want to welcome you all to this very important webinar today, which is discussing uh, student loans for people who are married. And we do this deliberately right around tax time because there are some special considerations, as you probably know, that people with student loans who are married must consider when it comes to dealing with student loans and taxes. So a little bit of housekeeping before we start. I'm going to be doing the presentation. Carolina is going to be behind the scenes answering your questions. So you will have to enter your questions into the Q&A box, which you should have on your menu. Whatever questions you have about the topic that we're discussing or anything having to do with student loans, feel free to enter those into the Q&A. I will stop periodically to allow Carolina to kind of ask additional questions or just maybe repeat some of the answers so that the entire group can hear everything. So with that, I'm going to share my screen and we can get started. Oops, something went wrong there. Let me try again. Okay. If somebody, Carolina, can you just confirm that you can see the screen?
We can see it.
Great. Okay, so today we're going to be talking about married and managing student loans in terms of the agenda. We're just going to go over, I'm just going to tell you a little bit about the EDCAP program for those of you that don't know about it. We're going to go over some important updates because there's obviously been a lot of stuff going on within the student loan world. I'm not going to spend too much time on that. And then we're going to get right into it to discuss the general strategies for tackling your debt, the various repayment options, and this all ties into what is the focus of today's presentation, which is the tax filing status question, because that's the big question that everybody who's married is going to have to answer around this time of year to do what's most efficient for your household when it comes to student loans and for your taxes. So a little bit about EDCAP. We are a program initiative of the Community Service Society. That's our parent company, or CSS. CSS is a large nonprofit or operating in New York City. It's been around for over 180 years. We were created in 2019 specifically to deal with the issue of student debt here in New York State. Student debt is a national crisis. There are about 46 million people with about $1.7 trillion worth of student loan debt nationally. That's the second largest consumer debt next to mortgages in New York. There's about 2.5 million, about $116 billion. We were some of the things that we do. We are a free service. We are set up to basically provide one-on-one counseling services for borrowers and to help you do things like determine your best loan repayment options, to access loan forgiveness, cancellation, and discharge programs, something that we did quite a bit of under the Biden administration. We can help you apply for consolidation, other types of applications like deferment and forbearance. We can act as an advocate and resolve issues that you might be having with your loan servicers and lenders. We can help you get out of default, stay out of default, prevent things like involuntary collections. And then we will also do some pre-college counseling, helping you understand your financial aid award letters. And we most recently have also gotten into helping people fill out their FAFSA applications. In terms of the updates, these are going to be, things are changing kind of at a rapid pace these days, but there are, you may be aware, some court challenges largely to the SAVE plan. The SAVE plan was the most recent income-driven repayment plan that was introduced during the Biden administration, the most generous of all of the plans. Two states' attorneys general from Kansas and Missouri filed lawsuits against the SAVE plan last year. A federal appeals court basically put an injunction on the Department of Education, preventing them from enrolling any new borrowers in SAVE or offering forgiveness through that plan, which ultimately led to the Department of Education putting everybody that was enrolled in SAVE at the time of the court injunction into a non-interest bearing forbearance that unfortunately does not count towards forgiveness. Now, people in the SAVE plan are going to remain in that plan, or in the SAVE forbearance would remain in that plan until the legal issues are resolved. But you can actually switch to other repayment plans. We're going to talk more about what those other options are right now. You can actually make a switch if you're in that SAVE plan, and you can file an application to switch your plan to one of the other income-driven repayment plans. You can do it online, but expect delays because the department really had not been processing any of these IDR applications for months. So they're a little bit backlogged. In terms of IDR plan availability, borrowers can apply for SAVE, but again, the applications are not going to be processed until the legal issues are resolved. But you can also now apply for all of the other plans. So IBR, which has two different versions, PayE, ICR. If you're considering another plan other than SAVE, we recommend IBR for new borrowers if that's your cheapest option and if you are eligible for that. If you don't qualify for IBR for new borrowers, probably the next best option would be PayE, again, if you meet the eligibility requirements. And if your income is high relative to your loan balance, you might actually want to look at ICR. So another thing that everybody should be aware of is that IDR recertification dates for anybody who was originally required to recertify in November or December of last year or January have been pushed back by 1 year. But borrowers may get requests to recertify starting in February and throughout the rest of 2025. You will not be asked to recertify if you're in the SAVE forbearance. For those pursuing PSLF, and we know that this has been a sticky issue, and who may be stuck in the SAVE forbearance, if you're close to the 120 qualifying payments, you might consider using the PSLF buyback. So that's to buy back credit for months that you might have been in a non-qualifying status, like a non-qualifying forbearance or a non-qualifying deferment. But you must have 120 qualifying months of employment on record to be eligible to do this. So if you're years away from public service loan forgiveness, you're not going to be eligible for the buyback. It's only really if, like, within the next, whether if you already have 120 qualifying months of employment on record, or you expect to hit that level in the next month or two. The other thing that you might want to do at this point is consider switching your repayment plans. Like I said, you can switch into these other plans. It may take time for the applications to process, but the servicers are supposed to put a processing forbearance, which is eligible for forgiveness for up to 2 months, on your account when you apply for a different program. It's just that they may not always grant that if you're already in the SAVE forbearance. But if you're just tired of sitting in the SAVE forbearance and languishing and without knowing when this is all going to end, then by all means, you can consider switching plans. The last option, if you're eligible and if you can afford it, is that some payments in the standard 10-year fixed repayment plan do count towards PSLF. So if you're eligible for that plan and it's something that you can afford, you can switch and make your remaining payments towards PSLF in that plan. But just remember, if you have consolidation loans, you may not be eligible for the standard 10-year fixed repayment plan. It has to be the 10-year plan. The extended versions of those traditional plans don't count towards forgiveness. And then for anybody who's in an IDR plan other than SAVE and is pursuing PSLF, just continue making your payments and recertify your IDR plans whenever you're asked to do so. And then borrowers can continue to file the PSLF certification forms to update your employment. We strongly recommend that you use the help tool, the PSLF help tool from your studentaid.gov account, and request an electronic signature from your employer. That is by far and away the most efficient way to file these applications right now. The IDR account adjustment, this was the one-time account revision that the Biden administration did to basically fix all the problems with income-driven repayment forgiveness and PSLF. That's the process that would have allowed you to accumulate retroactive credit towards PSLF and IDR forgiveness based on a set of relaxed rules. That account adjustment has been completed. Borrowers that had direct or Department of Education held FFELP loans are going to get the benefits of the program automatically. The accounts are in the process of they're being updated right now. There actually is now an IDR forgiveness tracker on your studentaid.gov account that contains the results of this effort. Payments, ID credit that you got towards IDR forgiveness, towards your IDR plan, can be turned into PSLF credit by filing those employment certification forms. But anybody that didn't consolidate their non-qualifying loans, like commercially held FFELP loans, Perkins loans, or HEAL loans, by June 30th of 2024, it's the deadline is over. So unfortunately, you will not be able to get the benefit of the IDR account adjustment, but you can still consolidate your loans and work towards different forgiveness programs going forward. And then just a word about navigating the current environment, because we know it's been very confusing during the Biden administration when there was a lot of borrower-friendly activity happening. It's probably going to get confusing in a different way going forward. And just with the litigation and the new administration, it's causing a lot of uncertainty within the system. So we just at this point strongly recommend that you keep good records. So you want to make sure that you take screenshots or download information off of your servicer account, like your loan details, any notifications that you might have received about your IDR plan. You want to look at your servicer account inboxes. If you have a PSLF tracker, and now that you have these IDR forgiveness trackers, you want to take screenshots and just capture as much data as you can, just in case something gets lost in some system transition going forward. And then err on the side of caution. You want to seek advice if you're thinking about doing anything that's complicated, particularly when it comes to consolidation. I will say that filing for income for repayment plans, if you wind up filing for a plan that you ultimately decide is not right for you, that can be changed. Consolidation, once that's completed, really you can't go back on that. So you want to get some advice before you do that. And then when you get this deck, and everybody will get a copy of this deck, to stay informed, we have some links to a couple of pages on federal student aid, the Department of Education, that are keeping us updated on the SAVE litigation. And then you can also subscribe to the EDCAP newsletter that we put out when there is important information to convey. Okay. So going into strategy.
Nancy, sorry, can I stop to point something out if you can help me clarify for folks? Is it okay?
Go ahead.
So there's a really good question about obviously switching income-driven repayment plans. And the big issue is when you switch over, the question is your new income going to be considered? And despite that, for those people who are in SAVE, for example, it has been pushed back, right? And the answer is yes. So Nancy, I don't know if you want to talk just a little bit about the logistics in terms of when you switch over from an income consideration.
Yes. So anytime that you file an income-driven repayment application, whether it's to enroll for the first time, recertify an existing plan, recalculate a plan, or to switch a plan, it's going to base the payment that they calculate for you on the adjusted gross income from the last filed tax return. So unless your income at the time that you place the application is lower than that number. So if you filed your 2023 taxes, if that was the last time you filed a tax return and you submitted an application today to switch your plan, the payment's going to be based on the AGI from your 2023 tax return. Now, if your income is higher now than it was in 2023, then the payment's going to be based on an income that's lower than what you have now. But I recognize that for people that have been that are in the save forbearances, or for many people, because the recertification dates have been pushed back due to the pandemic and then the legal challenges, the payment that your existing plan is based on could have been from many, many years ago and maybe a much lower income. So that's something that you're going to have to take into consideration. But at this point, anybody who's not in the save forbearance, you're in plans that are going to have to be recertified at some point over the course of the next year. And so it's going to be based on whatever your most recent filed tax return was or your current income. I hope that clarifies. Okay, so I'm going to go on now and discuss some basic strategies for tackling your debt, and all of this is going to kind of feed into what we're ultimately going to discuss, which is the tax filing status. So, we have determined, after seeing thousands of clients over the last 5 years or so, that basically everybody fits into one of three buckets when it comes in terms of what their strategy is for repaying their debt. The first bucket would be pay your debt in full as quickly as possible. Now, this is what people generally tend to think of when they take on debt is, oh, I'm just going to have to pay this back in full. Whereas you'll see in a minute, in the federal student loan system, there are other ways to go about this that don't necessarily require you pay the entire debt. This strategy is going to be best suited for people who have higher incomes, particularly compared to their loan balances. So they may have the ability to make more than the required monthly payments or lump sum payments that will allow them to pay their loans off faster. So even though they may be making more aggressive monthly payments, if your strategy is to pay your debt off, the faster you pay it off, the less interest you pay over the life of the loan. So that's bucket number one. Bucket number two, which is frankly where most of our clients fall, which is decide whether or not find out whether you're eligible for one of the forgiveness programs, pursue that program, and make the minimum required payment in your repayment plan until such time as you achieve the requirements to get your balances forgiven. So this is going to be for people with higher loan balances, low to moderate incomes. They're going to be for people who are pursuing things like public service loan forgiveness, IDR forgiveness. In that case, you don't really want to make extra payments. More often than not, you're going to wind up being in an income-driven repayment plan. When you're following this strategy, you want to just make the minimum required payments until such time as your balances are forgiven. And then the final strategy, which is a little bit depressing, it sounds like, but we have it there for a reason, is to pay the minimum required amount until your death do you part. And this is really targeted at older borrowers who maybe have Parent Plus loans that they took out for their kids, and they're either about to retire or they're in retirement, and they realize that the balance is such that they're going to be faced with paying it for 20 or 25 years. It's also people that maybe have taken out late in life did late in life degrees for themselves, and took those loans off when they were a little bit older, and now they're just sitting there and trying to pay them off. In this situation, if you're 50 or 60 and you know that it's going to take you 20 or 30 years to pay a loan off, that could well mean that you're going to be paying for the rest of your life. The strategy there is just find the cheapest option. It could be an income-driven repayment plan, could be a traditional plan, and make that payment until you pass. And the reason that we feel it's important to put this in here is that, unlike most consumer debt, federal student loans are discharged in death. So if the primary borrower passes away, the obligation of the loan itself does not pass to the primary borrower's estate or to their beneficiaries. And that's a big distinction. So that's why, you come up with the strategy, make these payments, knowing that there's not going to be a burden on your loved ones when you pass. Okay, I'm going to get now into choosing the repayment plan option, because this again is going to be key to determining what the right tax filing status is going to be for you. Um, as most of you probably know, there are two basic ways to make payments in the federal student loans system. There's the traditional repayment plans, where the payment's based on the size of your debt, the interest rate, and a predetermined payback period. So the traditional plans are like basically paying back any kind of regular consumer loan. So the fixed versions of these plans would be like paying back a mortgage, where you're making one monthly payment throughout the life of the loan, after which you've paid the entire loan, including all of the interest. The alternative to the traditional plan, if you can't afford it, and many people can't, particularly if they have larger loan balances, is the income-driven repayment plan, or IDR plan. And when I say income-driven or IDR, that's an umbrella term for 4 different plans, which we're going to talk about a little bit later. The benefits clearly here is that it's going to allow you to maybe make a payment that you can afford versus maybe the traditional plans. The income-driven repayment plans have offered forgiveness generally after 20 or 25 years of just being in those plans. That's aside from public service. That's different from public service loan forgiveness, where you're required to be in the plan and you get your balances forgiven after 10 years. It's going to be, these IDR plans are going to be required if you are pursuing PSLF or if you are pursuing IDR forgiveness. You can adjust the payments if your income declines on these plans, whereas you don't necessarily have that flexibility with the traditional plans. Of course, you do have to renew and recertify your income annually, which is a kind of an administrative headache, and one of the downsides of the plan, versus the traditional plans where you just enroll in the plan and you don't have that requirement. But the 4 income-driven repayment plans that we're going to be talking about are IBR, income-based repayment, payee, income contingent repayment, and SAVE, which is currently on hold. In terms of traditional plans, if you see the name standard, extended, graduated, or if your servicer account shows something that says level, those are all versions of the traditional plans. So I'm not going to go through all of the different features of these plans right now, but I just kind of wanted to review like what is available and what maybe not is available, what's not available at this moment. So as we discussed, the traditional plans, by the way, are all available. The income-driven repayment plans, SAVE, is currently on hold pending litigation. Income-based repayment, which has 2 versions, one for a borrower who had any loans that were dispersed prior to July 1st of 2014, you would only be eligible for IBR. That's the older IBR that calculates payments at 15% of discretionary income. If your first loans were dispersed on or after July 1st of 2014, you would be eligible for IBR for new borrowers, which is a cheaper plan with more attractive options. And then there's pay as you earn. That's also available. All of these are available if you meet the eligibility requirements. IBR is the only plan that's available to people who have FFEL loans. The rest of these repayment plans require that you have direct loans. And then income contingent repayment, or ICR, again, is available to borrowers with direct loans. This is the only plan for people who have direct Parent Plus loans. Direct Parent Plus loans are not eligible for any of the income-driven repayment plans, but if you consolidate them, you would make them eligible for the ICR plan only. So that would be the only plan available to Parent Plus borrowers that consolidate their loans. And we would urge anybody who's a Parent Plus borrower to reach out to us. There are some potential workaround strategies to this that may be temporary. They're complicated. Don't have time to go through them now, but you can reach out to us for a one-on-one, and we'll go through those strategies with you. And then I just wanted to mention revised pay-as-you-earn, or REPAYE. This was the predecessor to the SAVE plan. It's not available to borrowers right now, but depending on what happens with the litigation, it's possible that the revised pay-as-you-earn plan comes back. We don't really know, but I just put it on the chart in the event that it does. Okay, so now we're going to move on to the reason that we're all here today, which is to discuss the issue of tax filing status. So there are some unique considerations for married borrowers that don't affect non-married borrowers, or unmarried borrowers, I should say. Married borrowers, generally, you're going to have access to the same repayment options and forgiveness programs as your unmarried counterparts, depending on your eligibility for the various repayment plans and programs. But determining the right tax filing status is going to be a key consideration for you in making sure that we find the right payment options, and particularly for making sure that, if this is your main goal, is to have the cheapest repayment option available to you. And then there are a special set of rules that apply to the IDR plan calculations that are specific to married borrowers that other borrowers, unmarried borrowers, just don't have to take into consideration. So I'm calling this the 4 steps to determining the right tax filing status. We're going to go through these one by one, and then you can go back and just have them on the 4 steps for as a summary later on. So step 1, you want to determine if an IDR plan is going to be right for at least one of the spouses, at least one of the 2 of you. Now, this is where we kind of go back to the original, the initial portions of this presentation. Remember that IDR plans may be the best option if, one, you cannot afford the payments in any of the standard repayment plans, whether it's the 10-year version or the more extended versions. If your loan balance is very high compared to your income, or if you're pursuing certain forgiveness programs like PSLF or IDR forgiveness. And by the way, there's a whole when you get this presentation, I did break down all of the different forgiveness programs in the back of the presentation. I just didn't really think we'd have time to go through them all and get to the tax filing status issue. So you can review those forgiveness programs, and if you're not sure what you're eligible for, reach out to us and we can help you determine what you may be eligible for. So if any of these 3 situations apply to you, you're most likely going to want to be in an IDR plan. Now, if you look at between the 2 of you, if none of those apply to you and you both are looking to pay your loans back in one of the standard or traditional plans, you stop right here, because the whole issue of tax filing status is not going to impact you. Your tax filing status does not impact the payments that are made in a traditional repayment plan. So, but if at least one spouse is looking to pay through an IDR plan, then this is the process that you want to go through to determine what makes sense for you. Okay, so step 2, we've assumed that at least one spouse has determined that they're going to be in an IDR plan. The next thing you're going to need to do is calculate the payments for both spouses. If you both have federal student loans, if only one of you has it, then just one, filing jointly and filing separately, and compare the difference. So here's where we get into understanding how the payment plan calculations work for married borrowers. So if one or both spouses are enrolled in or considering an income-driven repayment plan, the tax filing status is going to be a key determining factor in figuring out how much you're going to be paying in student loan payments individually and as a couple. So for all of the current income-driven repayment plans, so that's IBR, Payee, ICR, and SAVE, if you file your taxes jointly, the payment's going to be based on the combined income of both parties. So basically, as I said earlier, it's going to go off the AGI of your last filed tax return. So if you file your taxes jointly, it's going to be based on that number. If you file your taxes separately, the payment's going to be based on your income alone. If you file your taxes separately, you cannot count your spouse in the family size, because you may be aware that when you fill out these IDR applications, it's always asking you about dependents. When you file taxes jointly, you consider the entire family size, including both spouses and any dependents that you're both claiming. If you're filing taxes separately, you exclude your spouse from the family size. You can claim children as dependents for student loan payment plan calculations if you provide more than half support for them, even if they don't live in your household. When filing separately, your dependents don't have to match what you do on your tax returns. So if you, the applicant, is filing separately, and you can just say when you answer the question on the student loan application that I am providing more than half support for my child, you can claim them as a dependent for student loan purposes, even if you're doing something different on your tax returns. Like I said, in most cases, the payments on the IDR plans are going to be based on the tax filing status from your last filed tax return. But if you're planning to change your filing status, you can only get the payments adjusted once you file a tax return with that new status. So Caroline, before I go on, are there any questions that have come up that we should answer right now before I get into the nitty-gritty of the numbers?
Nope, no questions. And as
Okay.
a reminder, if folks have questions, I know we're going to provide you with a lot of information. And as Nancy said, you might want to like absorb it and then step back. And obviously, if at any point you're still like scratching your head, you can always reach out to us and we'll do a one-on-one.
Okay, so I've got a couple of different case scenarios to show you how this kind of works numerically. So the first case scenario is a situation in which only one spouse has federal student loans. And this is a little bit more obvious in terms of how this is going to pan out. But we're going to use Margaret and Elon as our representative couple here. They are married and they have one child between the two of them. Margaret has $78,000 in federal student loan debt. Elon has nothing. Margaret earns $50,000 annually. Elon earns $75,000. Combined, they earn $125,000. The best IDR option available to Margaret is going to be IBR for new borrowers. So that's the calculation that these examples are based on. Ultimately, what we're going to find as a result of this, they're going to pay about $6,700 more annually as a couple if they towards their student loans if they continue to file their taxes jointly. So in this case, the monthly payment for Margaret in the IBR for new borrowers plan filing jointly, remember that's going to be based on $125,000, is $719. So that's it's based on $125,000 and a family size of 3. In terms of if she files separately based on her income alone, and her income is lower than her husband's, the payment is going to be $161 for the purposes of the student loan repayment. She's going to claim the child, so the family size is only 2. The difference, of course, on a monthly basis, she'd be paying $558 more on a monthly basis, almost $6,700 more on an annual basis for her student loan payments. And if they look at this as a household payment, that's the household that's going to be paying $6,700 more if they file jointly versus filing separately. So that's the first part of this process, is determining what you have to pay. Now, there's something called the adjustment factor if you both have federal student loans and you're filing your taxes jointly. So in this circumstance, one payment's going to be calculated based on the combined income and allocated to the person who's applying, who's filling in the application, based on their percentage of the total debt that they hold between the two of them. So let me break this down as to how this works. So in this situation, Margaret and Elon actually have a combined federal student loan debt of $130,000. So Margaret, the person who's filling out the application, has $78,000 in student loan debt. That represents 60% of the total, which is 130,000. So she's going to be responsible for 60% of that total payment that is being calculated based on that combined income. Elon has $52,000 worth of that debt. So he holds 40% of the federal student loan debt. He's going to be responsible for 40% of the total payment that's calculated. So even though his income is higher than Margaret's, he's going to be responsible for a smaller portion of the IDR payment that's calculated because he has a smaller percentage of the total debt that's held between the two of them. Now, when applying for IBR, payee, or save, the spouse of the person who's applying for the IDR application is not required to make a payment in the same repayment plan as the applicant. So if Margaret wants to pay in IBR for new borrowers, she will get that payment adjustment that I just described, even if Elon decides to pay in a different IDR plan, or he could even decide to pay in a standard repayment plan. He has no obligation to pay in the same plan that she has to pay in. The only plan that's not the case for is the ICR plan. If you want that adjustment in the ICR plan, both parties must agree to pay in the ICR plan. So let me just illustrate this with numbers. So again, we have both of them married with one child. As I said, Margaret and Elon have $78,000 and $52,000 respectively in federal student loans, same income as we had on the last example. And again, we're going to assume that the best IDR option for both of them is IBR for new borrowers. So in this case, you can see that in Margaret's case, if she was filing jointly, the comparison between filing jointly and separately is that she will save about $3,100 if she files her taxes, if they file their taxes separately. So her payment will be basically $261 lower if they choose to file their taxes separately. Elon, on the other case, on the other hand, will actually pay more if they file their taxes separately. He will actually wind up paying about $140 a month more if they file their taxes separately. But as a couple, if they choose to file their taxes separately, they will save about $1,452. So it all depends on how the household looks at these things. Do they look at it separately, individually, or do they look at this combined as a couple? So overall, in this example, they still save money if they file separately, but it's not as significant a savings as what they would have gotten if only one of them who has debt. And then I want to mention a word about the revised pay-as-you-earn plan. I mentioned before that it's not currently available, but if it comes back, married borrowers need to be aware that this is the one plan that that will consider combined income of both spouses, regardless of how you file your taxes. So this plan could wind up being a bit more expensive for married borrowers than it would be for unmarried borrowers. And it's just something that you should be aware of if this plan becomes an option at any point. And now there are some workarounds to this. If you're married but you're separated, if you're technically married but separated, or if you can claim that you have no access to your spouse's finances, you might be able to base the payment on your income alone, but it has to be a specific situation. So Carolina, I'm going to stop
So
because I'm sure.
there were two good questions, and I am gonna apologize. I think it was slide 24. In one of the examples, the question was, is this example claiming the child?
So yes, in this example, this is the one where only one spouse has federal loans.
Uh-huh.
We assume that Margaret, for the purposes of the student loan payment, is claiming the child as a dependent. So you can see there's a little asterisk at the bottom of this. It assumes a family size of 2 from Margaret when filing her taxes separately. Well, it's always going to be, if you're filing your taxes jointly, it's always going to be, you're going to get to claim the entire family. So the spouse plus all the dependents. In this case, the total family size is 3. That's the family size that's recorded for the payment filing jointly. But only a family size of 2 is recorded when if they file their taxes separately, because Margaret's Remember, Margaret's income is lower than her husband's and materially lower than the combined income. So that's why that payment is so much lower when she files, if she files separately versus filing jointly, even though she has a smaller family size.
Great. And related question, and I'm actually wanting to know the answer. And
Hmm.
obviously, I do this for a living, but I want to hear your take.
Okay.
If we're gonna differ on this one.
Oh, God.
Um, so if for purposes of the IDR application, can only one person claim the child as a dependent?
So yes, so you can't, if you're both filing separately and you have one child, you can't both claim that same child.
On taxes.
Well, and on the IDR application.
The IDR application says that if you provide more than half of the child support and they live with
Right.
you can put them as a dependent.
Right. But if you're both filing separately, you can't both say that you're providing more than half support, right? Then the math doesn't work. You can't, if one person is providing 51% of the support, then the other person is providing less than half the support, right?
I'm just thinking, obviously, this is a little bit more complicated, and I'm playing devil's advocate here. I'm just thinking, like, I guess they're still married. I'm just thinking couples that may be separated, and one decides to claim the kid 1 year and the other, but yet
Well,
one parent.
yeah, that probably gets into a more complicated decision. I mean, yeah, if you're separated, then you get into the whole thing. Like there could be arguments between the separated couple about what they're doing with their child on their tax returns. In which case that could lead to some kind of discrepancy with what they're doing on their student loans as well. Now, whether or not it would even be picked up in the student loan system, I don't know.
Yeah.
The chances are they would have less chance of it being picked up in the student loan system than it might be by the IRS. But
Okay.
they do periodically audit these things. So,
So yeah, okay. So someone asked like blank the question that I was trying to get at, and I'll give my unsolicited sense. And here the question is, can a different spouse claim dependent child for taxes and then the other spouse claim dependent child for repayment purposes? In scenario one, where one spouse has loans. So,
yes.
and someone else, wait, what was that?
Yeah, the answer to that question is yes. For tax purposes, right? The question was, can one claim can one parent claim the child for student loan purposes and the other claim it for tax purposes?
Yeah.
Yeah. Yes.
I thought that was a discussion that we were just having that you were
I
thinking.
thought, okay, I think I thought we were discussing whether they can both claim the dependent for student loan purposes if they file their taxes separately
Yeah.
on the IDR application.
Which is this question? Okay, so
I
I'm gonna
think
give my 2 cents, Nancy, you can add. Generally, when you are doing an IDR application, there is an automatic IRS retrieval tool. And the IRS retrieval tool will look at how the borrower filed their taxes and they will verify the household size based on the dependent's claim on the taxes. Now, when you're doing the IDR application, when it's fully functioning, if you try to add a dependent that it's not accounted for in your taxes, if you're filing separately, the system will tell you to verify that that is accurate because they're doing this data match. So my takeaway is obviously they will be checking mostly the IRS data matching to see what you're claiming. Now, if you have special circumstances, um, you can look more into it. You can definitely read the statement on the IDR application and then go by that statement, which again, the general statement, don't quote me on it, if you provide more than half their support and they live with you. Now, it can get tricky if you're still married about filing separately. The IDR application goes a little bit into this. I don't know if you want to say more on that part, married but filing, but but filing separately. Well, that's the whole basis of this presentation, right? Anyways, I'm rambling. Let me just review some of the questions, and then if we don't cover them, then we can come back to them. Okay?
Okay, I'm going to say just a couple of words because I fear we might have confused some people here.
Probably.
And I think you and I are maybe trying to answer two different questions, but I do want to make it clear that and this kind of goes to what Carolina was just saying, that if you are filing your taxes separately, let's say, and you're the applicant and your spouse has claimed the child, you have one child, and the spouse has claimed the child on the tax return, you can still claim that child as a dependent on the IDR application um, for yourself if you can answer that question about providing support honestly, that you do provide more than half support for the child. Because I know that there are instances where sometimes you know people do these the dependent allocations if they're filing separately in different ways. Now, in terms of the application, how that works itself, as Carolina was saying, in the system is set up to do an automatic data retrieval through the IRS database. Right now, that's actually not working, and you have to upload your actually hard copies of your tax returns, which would also have the dependents on there. The way to make that work, if it's not being reflected on your tax returns the way you want it for your student loan payment, is when they ask you the question, do you expect your family size to change? You would say yes to that and then claim the dependent that way. So if anybody, like I've actually done that with clients, if anybody needs help with that, reach out for a one-on-one and we can go over that. So I hope that was clearer. Carolina, are there any other questions on the calculations that we need to discuss?
So not on the calculations. I mean, I think just like emphasizing the whole point. If you're married and you file jointly for purposes of an income-driven repayment plan, they're going to look at line 11, the adjusted gross income, to figure out your monthly payment. To bypass, and the purpose of this presentation is really a question of like, does it benefit you from filing separately? And each situation obviously is going to be different, right? So if your husband who doesn't have loans is the very high earner, you may consider filing separately. Now, if you have a child, there's another conversation of who claims the child. Well, if your husband is the super high earner and you have very little income, it may be financially more beneficial for your husband to claim. So we are just discussing and giving you information on the student loan angle. You may need to either, if you do your own taxes, run some scenarios for yourself, or if you have a tax accountant, run some numbers comparing those numbers that you get of what's the difference from a tax benefit if you file jointly. And I think now I'm going into step 3. Never mind. Let me be quiet. I'm going to answer more questions behind the scenes.
Yeah, so actually that is correct. We've now only done steps 1 and 2 of the process. So the first portion, which is where we can really help out, is determining what your student loan payments are going to be in the different tax filing statuses. Step 3, though, is there's another big piece of this whole process, is you have to take that information and consult an accountant, or as Carolina said, if you're able to run these numbers yourself, do some kind of comparison that looks at the amount of money that you're going to be able to save in a student loan payment in that particular tax filing status, and then compare that to what the impact of that tax filing status is going to be on your actual taxes. And we are not accountants, so we can't do that portion for you, but we can arm you with half of the information because usually the accountants can't figure out the student loan portion either. So this is where we add the accountant input, okay? In case scenario 1, we've determined that the couple is going to save about as a couple, they're going to save about $6,700. This is where the only one spouse had student loans, and they're going to save almost $6,700 if they file their taxes separately. Now, It's my experience, and again, I'm sure there are exceptions to this rule, but it's my experience that in most cases, when people file their taxes separately, they wind up paying more overall in taxes versus what they would have to pay if they filed jointly. There's a benefit to filing your taxes jointly. And for the purposes of this exercise, I have determined that that benefit is $3,000. This is a number that this is not an accurately calculated number. This is just a number that I put here for to demonstrate the process. So in this situation, in the first scenario, they're going to save $6,700 in student loan payments if they file separately, but they're going to pay $3,000 more in taxes. So net, they're basically going to save $3,700 more if they file their taxes separately overall, between doing the comparison. In the second scenario, still filing separately, they save money, but a lot less than they did in the first scenario. They only saved about $1,450 in student loan payments. And now they're going to have to pay $3,000 more in taxes as a result of filing separately. So in the second scenario, they actually pay more money overall between their student loans and the taxes if they file their taxes separately. Over almost $1,550 overall. So that's the where the accountant input becomes critical, and you really need these two pieces of the puzzle in order to come out with the right eventual result. And then step 4, I call this the final decision, because while in most cases people are just going to look at the numbers and do what's cheapest overall, there are some qualitative decisions that can be made. So while saving money, like I said, is usually the major decision, there are sometimes other factors that people weigh in. Number one, do you count either individually or as a couple on a big tax refund on an annual basis? Sometimes people do, and if they want that tax refund and you file separately, you might not get that lump sum or not get it as big a number. Number two, how do you guys look at your finances as a couple? Do you look at as people, each one of you taking care of your own finances separately, or do you look at all of your expenses as the responsibility of the household? That can be a defining factor. I can give you an example. I had a client a couple of years ago, a woman who she only had student loans. She had sizable student debt. Her husband didn't have any student loans. He had significant income. She had very little income. And it was very clear it was going to save them a lot of money as a couple if they filed their taxes separately, and he wouldn't hear of it. He just didn't. He said, that's not my responsibility. It's your responsibility. And so sometimes that's what is the deciding factor in these conversations. But the bottom line is, if you go through this process, you're going to have enough information to make a fully informed decision. And that's what this whole exercise is about, is just giving you enough information to make a fully informed decision. Other things that you need to know about this whole process, unborn children. So if you have applied for an IDR plan, you get your monthly payment, and then you become pregnant in between the recertification dates, you can actually go back and recalculate the plan and count the unborn child as a dependent. So as soon as you know you're pregnant, you can actually recalculate your IDR plan. So just be aware of that. If you are submitting an application and you are married and filing separately, and married and filing jointly, and sometimes even separately, you may be asked to supply information about your spouse. So generally that's going to be their name, date of birth, social security number. In the past, the spouse would actually have to co-sign on it. It was ridiculous. Now you just have to put verifying that information in the system so that they can verify that what you're saying is correct. If you're married but separated, or you can't, I think I mentioned this earlier, you can't reasonably access your spouse's financial information, you can base the payments on the IDR plan on your own income. Um, Forgiveness programs in the federal system are available to married borrowers just as they are to unmarried borrowers, but the person who holds the loans has to meet all of the program eligibility requirements. And then just remember, I mentioned it before, that federal student loans are dischargeable in death. So if a married borrower dies, their debt doesn't become the obligation of the spouse, and that's not usually the case with other types of forgiven consumer debt, whether it's a private student loan or any other kind of consumer debt. So that's it. Carolina, I'm gonna open it up again and see if there are any other questions.
Okay, yeah. So, I feel like a couple of questions. One question, Nancy, if people want to play around with the scenarios of what their payment would look like, what calculators or
Yeah.
resources do you recommend? I typed in the Q&A or EDCAP calculator, um, and the
Well,
yeah, go
no,
ahead.
sorry, go ahead.
I was just gonna try to bring it up and show them really quickly of how you play around with it.
Okay.
The only caveat is that it doesn't have ICR in it. And the reason why I'm saying that is because one, we should let you know, most people are not gonna end up choosing ICR because it's the most expensive and there's other caveats. However, do you want me to pull it up from my end? Um,
Well, I just want, well, I can pull it up. The thing that I want to mention though is that the one thing that the EdCap calculator does not do right now is it won't calculate that married borrower adjustment if you're both married and filing jointly. So it's just going to give you a straight number. Let me pull it up and see if I can.
So, and as you're pulling it up, one thing I want to mention about the ICR, and someone asked about their specific situation, I provided my email because I think it merits a discussion. Generally, the ICR is the least favorable because it considers up to 20%, it considers 20% of discretionary income or the monthly payment to pay off the debt in 12 years. So in the scenario that was presented, the borrower has, um, let's say $40,000, their income is high. That's the one scenario where I may explore ICR.
Yeah.
And if ICR is lower, um, it's considering probably not the income, but the ability to repay it within the 12 years. Anyways, it can get really complicated, but there are some very specific scenarios where your loan balance is low in comparison to your income where ICR. But Nancy, do you want to talk about how this is just an estimate? You always want to verify, but do you want to talk about it?
Um, Okay, so well, I'm gonna let me go through the calculator just to give you an idea of what the calculator is going the calculator that Carolina was referring to is going to show you. The limitations of this particular calculator is that it's going to give you basically the result of how much you would pay um, if you were filing your taxes separately. So let's say your adjusted gross income, you alone, is $80,000, um, and you're going to claim one of the kids, and you have $50,000 in loans, right? Um, it's going to then give you the calculation of what you would pay in income-based repayment. This is the old one that calculates payment at 15% of discretionary income, in pay-as-you-earn or IBR for new borrowers, which is essentially the same calculation, so cheaper, and then save, which is not available. So it's really, you're going to be looking at these two payments right here. So it's going to say that, you would obviously, let's say they were eligible for IBR for new borrowers, the payment would be $411. Now, if the spouse also had, let's say the spouse made $50,000 and they were only claiming themselves, they're not going to claim the child. And let's say the spouse has, I don't know, 42, or let's say $65,000 in debt. Um, if the spouse were filing separately, they would pay $228. So that's what you're able to do on this calculator. The one piece that this calculator will not do is tell you what that payment adjustment is going to look like if you are filing jointly and you both have federal student loans. I think the FSA loan simulator may be able to do it, but it's not straightforward. You would basically have to put in two different calculations, one from the perspective of the applicant and one from the perspective of the spouse in order to get the right information. And even then, I'm not sure how accurate it is. I guess my best advice really is, and I know that this can get a little bit complicated, is to just reach out and we'll do a one-on-one with you and work out the numbers. I apologize that we're working on calculators. It's very complicated to put these things up, and particularly to add the ICR plan, as Carolina was mentioning. Now, I will mention that we may have a calculator up on the website soon that would do that calculation if you are a Parent Plus borrower, but it's only going to show you the ICR calculation because that's the only plan that Parent Plus borrowers are eligible for. So it is complicated. The federal student aid calculator is not always 100% accurate when it comes to stuff like this. So your best bet is probably to reach out and do a one-on-one with us.
Thank you, Nancy. And it's already 1:04, so we want to be mindful of time. We hope that this was useful. Again, the big question is, are you filing jointly, separately? There's a few steps. Everyone who registers is gonna get a copy of the recording and the PowerPoint presentation. And again, if you feel you still benefit from like the one-on-one, everyone should ask for Nancy. She's our expert. She's gonna hate me, but we'll help you out. Not only Nancy, other counselors can also help you run some numbers to give you a better idea. Thank you.
All right. Thank you, everybody.